Welcome to the Big Money Questions show. I'm Rachel Rickard-Strauss, personal finance editor at This Is Money. This week, what is the FTSE? We hear FTSE all the time on news briefings, but what does it actually mean? John Redwood is going to explain it to us. He is the global chief strategist for Stanley. Thank you so much, John, for joining us. May I ask you straight from the top, what is the FTSE?
Well, the FTSE is a group of indices, as they're called. It's a number which tries to sum up how the stock market is doing. And there are different FTSE indices. There's a big company index, which just looks at the top 100 companies quoted on the London stock market. And then there's a FTSE 250, which takes company in size 101 to company 350 in size, if you listed all the companies by size. And then there's a smaller company index, which takes the companies that are smaller than those in the 250 and in the 100. And by size, we mean what is the value of the company. And we value a company in terms of how much all the shares in the company are worth. So that if you had a company with 1 million shares and the share was priced at a very timely £1 to make the sum easy, then obviously you've got £1 million of company. And so that in the index would be £1 million of market capitalisation, as we call it, £1 million of company worth, and you put together all of the company worths of all the different quoted companies and you create a single figure on index. And why do you want to do that? Well, people want to know whether the market as a whole is going up or down, but on any given day some shares are going up, some shares are going down, so the idea is to look at the whole lot of them, put them together as a single number. And if there are more going up than going down, then we say the index has gone up, and if there are more going down than up, the other way around. But we also take into account the value of the company. So if a big company is going down, it has a bigger impact on the index than if a small company is going down.
Okay. And why does it matter to people? If you aren't someone who trades in stocks and shares, why should you listen out for that FTSE number?
Well, a lot of people are involved in the stock market in ways they perhaps don't fully understand. I mean, if they have a pension fund, they're going to get a future pension from their employer, or if they've got personal pension savings that a manager looks after for them, or if they've got a long-term insurance contract, they will be invested in shares as well as in other financial assets. And so their individual wealth is tied up in the stock market. Now, these are usually long-term contracts, but if over the longer term stocks and shares do badly, you'll get less pension or you'll have a less good payout from your insurance savings scheme, so you're interested. But even if you've got no financial wealth at all, you should still be interested because you've got a job. If your company is exposed to lack of confidence, for example, you might lose your job because there aren't enough orders. That lack of confidence can start in the stock market. And if you see day after day the stock market tumbling, the stock market is trying to tell people running companies something. It's saying, beware, there's trouble ahead, you won't have so many orders, and that might knock on. And then your company and its boss might say, you know what, the stock exchange may be right, things are getting worse, I'm afraid I've got to shed some labour. So confidence is a precious flower, and one of the ways of seeing whether the flower is blooming or not is to see whether the index of stocks and shares is doing well.
So in a sense, you can see these FTSE indices as a kind of barometer for our economy in general. Going up looks good, going down, less confidence.
Broadly true, but the index of very large companies has companies that trade all around the world, and a lot of their wealth and income comes from America or Asia or Africa, not just from the UK. So it's not a pure barometer just of the UK economy. The smaller companies are mainly the UK, so that gives you a better guide to what's happening in the UK. But of course the UK, like all the world economies these days, is very dependent on the world itself. And so if the world economy is going flat, if America and China started to go flat, we'd probably get dragged down with them. And that is captured quite early by the index of the big stocks as well as the smaller stocks that are more domestic.
We tend to focus on the FTSE 100, these top 100 companies, and it sounds from what you're saying as if there's also a place for, as important, to look at the 350 or the 250 perhaps, the 350 for the state of the UK economy because it tends to be more UK focused companies, and then the 100 gives you a sense of what's going on here but also what's going on around the world.
Yeah, that's right. Or you could go down even more on the size scale and go to the smaller capitalisation companies that come in after the biggest 350, and then you've probably got even more UK content to give you an idea of how well the UK itself is doing. But generally, the UK isn't going to prosper if the world itself is falling to pieces, and so the 100 isn't a bad indicator of whether you should be optimistic or pessimistic.
Why are there non-UK companies listed on in the FTSE 100 on the London Stock Exchange?
Well, the FTSE 100 is a curious index because it has quite a lot of mining and commodity stocks that have most of their assets well away from the United Kingdom, and it has some very big oil companies that have a lot of oil wells also well away from the United Kingdom. And I think commodity companies in particular are attracted to London because it's one of the really big liquid share markets of the world.
Liquid.
Why does that matter? It means that there are lots of rich people and institutions trading in London, so there's plenty of money around for buying and selling shares. And if you've got your shares quoted, you want to know on the day when one of your shareholders wants to get out, they can get out at a decent price. So you need a market where there are plenty of potential buyers. Whereas if they quoted themselves in the country where their big mine was, for example, it may have a rather small stock market, and it wouldn't have access to all those people and institutions that could take the shares off the unwilling shareholder or the shareholder who needed his money in a hurry, and that would be more damaging to the share price. I think the other reason is that these companies, of course, from time to time want to raise money. Prime function of a stock market is to raise money for the company, risk money as it's called, so that you get money off shareholders. You don't ever have to repay it as a company. It's yours to use. The shareholder, of course, can sell his share on if he no longer wants to keep holding it, but it's better money than borrowing because the company doesn't have to repay it at any point, and it doesn't have to pay interest. The company pays a dividend if it has profits, but if there's no profits, it doesn't pay a dividend. And again, it's a good idea to come to a market with lots of people who might buy your shares and who are interested in shares, and so the big markets, Wall Street and London, tend to get a lot of the listings for that reason as well.
And can any company that chooses list on the London Stock Exchange, or are there limitations? No,
there are limitations because another important characteristic is that to get listed on one of the big world exchanges like London, you need to meet certain standards. You need to show you've traded successfully. You need to show that you've got in place a good board of directors who will include independent criticism of the chief executive and who will be able to report to the shareholders in an open and honest and timely way. So you've got to show that you will look after all your shareholders, however small they might be, that you will make honest reports to them, you will pay them dividends if you've got the money to do so, and people want that comfort of knowing that there is a big stock exchange like London keeping an eye on these companies, because if a company failed to do all those things, then it would be taken off the stock exchange, because the stock exchange would have to say you're not meeting the requirements of honest dealing and good company government.
The FTSE indices aren't set in stone, are they? Say, for example, the FTSE 100, those 100 companies shift about all the time.
Yes, indeed. There are promotions and relegations at regular intervals where the people who make up the index say, well, the companies in the top 100 now, some of them aren't really big enough to justify being in the top 100. They're not the biggest companies, and some of the companies down below should be promoted. And so there's a continuous system of making sure that the size is right in the index. So they have to change the companies around in the index, and you get promotions and relegations. And so over a period of 20 or 30 years, there are very big changes indeed, because we don't probably notice it in our daily lives, but there are huge losers and winners in the free enterprise business of changing company fortunes. And so things that were very popular and very big 30 or 40 years ago are no longer with us. I mean, just think of all those quoted automobile companies we had in the United Kingdom in the 1960s and 1970s. Those who have that longer memory, they're no longer quoted companies. British motor cars are now made by foreign companies in the main, whereas we've now got a lot of mobile phone companies, technology companies and so forth doing things that weren't invented in the 1960s or 70s.
Can we talk about the specific number, the FTSE 100, which is talked about so frequently? It's a bit above 7,000 at the moment. What does that number mean?
Well, it doesn't mean a great deal, really. It means something to market professionals, but I would say to people, be interested in the rate of change in it. If it's broadly going up week after week, month after month, then you can be a bit more relaxed because it's not a bad indicator. It implies that things aren't going too badly, that there's quite a lot of confidence around. If it's going down month after month, you may be starting a crisis. I mean, the last time we had a really serious big set of falls in the FTSE 100 and the other indices was at the time of the crash at the end of the last decade, and it was signalling something very serious. And at the beginning of that process, I think quite a lot of people saw it on the news, because if you get big falls, it becomes a lead item on the news, and they thought, oh, well, that's going to hit rich people and serve those bankers right, some of the sort of feeling of it. But unfortunately, it wasn't as simple as that, because the bankers' pain today became everybody else's pain tomorrow, because it meant that the banks were in trouble, and then you had the economy generally in trouble, and then factories were closing, jobs were being lost, everybody was being squeezed. So it was the right time to worry that the big falls in the FTSE towards the end of that decade signalled a very real crisis.
So it's the movement of travel that we should be interested in when they talk about big drops or big gains. That's more interesting than that specific number, because it's an index compared to itself, really. It started at 1,000 in 1983, 84, and it's moved up since. But the fact, I wanted to ask you, the fact that it's gone from 1,000 to 7,000 something, does that mean that the size of the top 100 UK companies is sevenfold what it was?
Yeah, it means that we've got some much bigger companies with much more stock market wealth in them, but I don't think there's any great significance in the actual number, and it's better to look at what has actually happened in terms of jobs growth and income growth. We are richer than we were then, but we're certainly not 7 times richer than we were then as a community, so it exaggerates what matters, which is real living standards.
Okay. And I want to ask you finally, the specific phrase that we use, FTSE, is FTSE. What's that?
Well, it's the Financial Times Stock Exchange Index, and it's because the FT used to be involved in it, whereas now these indices are in the possession of the London Stock Exchange, and you can go to their website and you can see there how they construct them. It's quite a complicated formula to work them out on a regular basis, so they can publish these regular updates during the trading day and then at the close of the day, so that we can see whether things are broadly getting better or broadly getting worse. And you need to look at it over a period of weeks or months. It's not very meaningful what happens today or tomorrow, very difficult to predict, and it may be a sort of odd news item or a few big sellers or something, but you need to look at the long-term trend. Okay,
so FT is out the picture now, but we still hold on to that name FTSE, but
it's a good brand, so I guess why change it? Because the whole point about an index is it has to be memorable, and we all seem to remember that.
Thank you, John, very much for talking us through that, and thank you for joining us for the Big Money Questions.